We will go ahead and call the City of Murfreesboro Pension Committee meeting to order. Today is August 21st. Do we have anybody sign up for public comment, Frida?
No.
Okay. So our first order of business is to consider minutes of the March 20th, 2024 and July 17th, 2024 meetings.
Move to approve both as submitted.
Second.
Okay, all those in favor?
Aye.
Aye. Any opposed?
Aaron,
Okay.
Aaron, I got to call roll.
Oh, yeah, you can do that. I think it's fine, but go.
Oh, okay, go ahead.
Oh, you need to call roll?
Well,
It's fine. You can go ahead and call roll, and we can have it formalized.
do I need to do them separate or just one?
I think just one, since it's one agenda item.
Okay. Amanda DeRosa? Aye. Earl Hall?
Here.
Greg Sample?
Aye.
Kathy Smith?
Aye.
Chair Tucker?
Aye. Okay, our next order of business is to consider appointment of a vice chair. Since Ms. Brown is no longer with the city, the mayor appointed Mr. Roja as our finance department representative. I would recommend considering appointing Mr. Roja as vice chair. That way, if I'm not here, then she can fill in my absence. Can I get a motion?
Make the motion.
Okay. Would you call the roll, Frida?
Amanda DeRosa? Aye. Earl Hall?
Aye.
Greg Sample?
Aye.
Kathy Smith? Chair Tucker?
Aye. Congratulations, Amanda.
Who seconded
Always wanted.
Who seconded
Just
that?
doubled your pay.
Kathy, did you second that? I did. Okay, thank you.
Okay, so our next item is to review the Acrisure recommendations. Acrisure is our actuarial firm. At last month's meeting, Amy Krause from Acrisure presented quite a bit of information to the committee. I don't know if either of y'all were able to go back and listen to the meeting from I guess it was July 17th, but it was really good information. You should have the slides from her presentation in your packet as well. Amy is not on the call today, but I can just briefly give you kind of a Cliff's Notes version of what was discussed, and then we can see if anybody wants to make a motion to approve those assumption changes. So the first item that Amy discussed was updating our mortality table to align with actuarial standards. This is a pretty standard thing we do every, I think, 5 to 7 years. The new table that she's recommending was published in 2019, and our current table that we're operating off of is from 2006. So pretty dated there. And then, I'm sorry, it's based on 2006 mortality data, but it's the 2010 table. So we've got a recommendation to update that assumption to the new mortality table. The impact of that has an increased liability of about $500,000 in our annual contributions. And she did point out that this is the most commonly used mortality table, and the TCRS plan is also using this. And then she also recommended moving forward to just state that the plan will use the most current mortality improvement table from the Society of Actuaries, and that will update in future years, since we're updating it right now, assuming the committee approves. And this will allow for smaller incremental increases each year versus these big $500,000 increases. And then I think the last, let's see, that needs a motion, Sorry, I went back and listened to the meeting to make sure I covered everything. One of the other assumption changes was a form of payment election assumption change. Currently, the assumption that the actuaries use is just that everybody chooses a single life annuity, and she recommended changing that where they base their information off 60% of the population choose a single life annuity and 40% choose a joint survivor annuity. So the cost impact there would reduce our annual contribution by $150,000. So netting the two assumptions, we're at, the first one was a $500,000 increase, the second one was a $150,000 decrease. So that would reduce our overall liability by, or increase our overall liability by $350,000. Let's see, our funding policy was also discussed and how we amortize that. I think I'm not going to go into all of that right now. There's information in the slides that I think is very helpful. We will revisit that topic in probably 2026 or 2027 to look at moving towards a layered funding policy approach versus just a single approach where we pick a certain date and time to amortize our gains and losses. But I'll let Amy discuss that in more detail. It'll probably be 2 years before we come back to the committee with that. There was some other discussion that she had with the committee as well, and one thing she did, we talked about, Mr. Sample brought up the possibility of the plan purchasing annuities down the road since it is a closed plan, and Amy suggested pricing annuities now for our current retirees to see what that would look like because interest rates are in our favor right now. I expect to get some information back from her in the next week or two about what that looks like, and then if we think that's something we might want to move forward with, then we'll bring that back to the committee on what that cost will look like.
So what would that mean is we would just carve out those folks from the plan, and they would just be set aside, and the annuity would cover them, and we would have a smaller pool of people to deal with.
Exactly. And then, which I think every year we talk about this, we currently fund the plan on a percentage of payroll, but we are getting, because our active participants are shrinking each year, that percentage of payroll is going up a good bit. And so we're getting closer to needing to look at just saying, instead of funding on a percentage of payroll, just getting a flat amount and budgeting off of that instead of off of the active participants. And the example I always use when I talk to the city manager, anybody else about that is, I was one of the last people hired on our pension plan, and in 20, or not 20, I'm retired in 20 years, but in 12 years, if I'm one of the last active participants left at the city and we're contributing, 800% of my salary to the plan or something, that's not for me, that's for all of the participants. So it makes sense to look at funding on a flat rate at some point. So the items that we would need a motion on for the recommendations would be to change our mortality table and to update our mortality improvement table to the most current used by the Society of Actuaries, and to change our form of payment elections from that 100% assumed single life annuity to a 60-40 split between single and joint survivor. I think that those are the only changes. Again, those result in an impact of about a $350,000 increase in our annual contributions. I'm happy to answer any questions, and Amy said that we could call her if we had any questions or email her as well, and if the committee would like any additional information, we can do that. I know that was a very quick, rapid
It was very good.
relay of all the information, but are there any questions?
We confirmed with Amy that the, following the new mortality schedules is consistent with the new Tennessee law. right? Was that?
I would assume so. I will confirm with her. I can't imagine that she would recommend it if it wasn't following that.
Right.
I'm not sure what you mean for the
I
mortality.
thought didn't we email her asking her about it because we had seen,
I'm not sure, but again, she said TCRS is currently using the mortality table that she's recommending, so I would assume that that would fall in line with that.
Aaron, do you need that in 3 motions, or can you do one motion?
I think we can do it as one motion to approve the Acrisure assumption and funding method recommendations.
So moved.
I'll second.
Okay, could you call the roll?
Amanda DeRosa.
aye.
Earl Hall.
Aye.
Greg Sample.
Aye.
Kathy Smith.
Aye.
Chair Tucker.
Aye. Okay, so our next item was to consider the Acrisure pension engagement, and they sent us an engagement contract for 4 years. And the primary reason for this is they also do our OPEB study, which is done every other year. And so it helps us to align those contracts so that we can keep everything moving for audit purposes more than anything, and we don't have to come back and meet just to approve a contract each fall. The fee is based off this year's fee of $40,000, which with $1,000 incremental increases each year. I will say, because we needed to get all of this moving for this year's audit, I went ahead and took this to City Council for approval after the last meeting, since we didn't have a quorum at the last meeting. But I think it is still a good thing for the committee to consider, and if for some reason the committee did not, agree with that, then we could always go back to council with a different recommendation. But if the committee is fine with sticking with Acrisure,
So
then...
council did approve it?
Yes, they did. Then, we can go ahead and approve that today as well.
I have no objection to the city council's action, so.
Okay.
Move to approve.
Okay.
Did you make a motion?
No, I just, I don't,
okay.
I mean, I'm fine with what the city council did, so.
Okay.
So unless we want to contravene them, I don't see.
Yeah, I don't know that there's a need to
Right.
vote on it
Okay.
necessarily, so I think we're good there. The next item is a special invoice from Acrisure, and this was for the assumptions and funding recommendations that Amy presented to us. This was outside the scope of their normal contract, and that has not been paid yet, so we do need committee approval for that.
Move to approve.
Second?
Okay, would you call the roll, please?
Amanda DeRosa.
Aye.
Earl Hall.
Aye.
Greg Sample.
Aye.
Kathy Smith.
Aye.
Chair Tucker.
Aye. Okay, I think that is all of our work to get everything approved. Next, we have Nataka from Fiducian Advisors on the line, and I think we have Chris Rollins as well. So welcome.
Thank you, Erin. We're going to do a review of the second quarter performance report, and since that is a little dated, Chris is also going to provide an update through July, covering your July monthly flash report, and an update through August 16th, as the markets in August started off in a volatile fashion, shall we say.
Yeah.
Yes, okay. So if you have the second quarter reports in front of you, I can reference some page numbers to follow along. But on page 11 is a review of financial market performance during the second quarter to give you a little bit of an idea of what environment your investment managers were operating in the second quarter. And at the top of the table are global fixed income markets. And in the quarterly column, you can see that most of the numbers are flat to slightly negative. Interest rates did rise a little bit during the second quarter, and that put pressure on the fixed income markets. The best performing segments of the fixed income markets were actually the riskiest. High yield bonds and were top performers. The plan does have exposure to high yield and multi-sector bonds, so that was a positive in the second quarter for you. And then also short duration and money market or T-bills also posted positive returns for the quarter. If you drop down to the middle of the table under global equity markets in the quarterly column, once again, you're unfortunately going to see a lot of minus signs. The positive performing segments of the equity markets in the second quarter were large cap growth stocks. They were positive. Once you drop down into mid cap and small cap, and also the entire value complex from large, mid to small cap posted negative returns in the second quarter. Internationally, developed markets had a very flat to slightly negative quarter of performance. Emerging markets were strong. They were up 5%, similar to what U.S. large cap growth stocks were doing. In the bottom section of the table, there is the performance of alternative asset classes such as REITs, real assets, and commodities. REITs actually posted a relatively flat quarter of returns. Interest rates were still high. That puts pressure on the REIT market. And commodities were also slight positive. Oil was good, but things like industrial metals and agriculture were on the weak side. So that's sort of the backdrop for the second quarter of performance. If you turn to page 13 of the report, that's the portfolio dashboard, has a lot of information on your plan's market values, performance, and also asset allocation. In the top right-hand table, you can see that your plan began the quarter at $180.1 million and finished the quarter slightly lower at $178.9 million, almost $179 million. You had slightly then higher outflows. Your net contributions or net withdrawals in this case were $858,369, and you had a small investment loss, $258,957. If you move over to the left side of that page, you see the performance table. And so for the second quarter, the plan posted a very slightly negative return, minus 0.1%, which lagged a slightly positive target policy of 0.4%. On a year-to-date basis, meaning January through June 30th, you were ahead of target at 4.5% versus a 4% return for the target. And also June 30th marked the end of your fiscal year, and that's an important number. A lot of your actuarial assumptions, a lot of what you book for the year is based on your fiscal year return. And there you edged ahead of target for the fiscal year, up 10.7% versus a 10.5% target. Your actuarial assumption rate is 7%. That's another important number that your fiscal year-to-date return looks to equal or top. So for 2 years in a row now, you've had quite strong fiscal year returns, which will help with your funding ratio and funding policies going forward. I am now going to just do a quick review of performance, really from a composite team level. If you turn to page 21, that starts off the performance detail. So as I said, your plan posted a minus 0.1% return for the quarter. You have 4 investment teams in place. Your fixed income team actually finished edged ahead of target, was up 0.4% versus a 0.3% target. You have 5 fixed income managers in place, and you can see them on page 22 of your report. All of them finished in positive territory in the second quarter, and all of them either matched or edged ahead of their targets. The best performing managers on your fixed income team, much like they were for the indices, were the Western Asset Income Fund, which is a multi-sector bond fund, up 0.6%. And then on page 23, the Lord Abbett High Yield Bond Fund, up 1.5% for the quarter. But still very strong performance results from your fixed income team. And that's important because you might recall that as a result of the strategic asset allocation update that we instituted this year, you're going to be increasing your exposure to fixed income from 34% to 44%. So it's important for your fixed income team to generate good results, and indeed yours is doing just that. We're moving towards that new target in tranches. We're dollar cost averaging in, and I'll provide an update of that when we cover asset allocation in a few moments. You have 6 domestic equity managers on your team. That team lagged its target index in the first quarter. The index came in relatively flat at a 0.1%. Your team was a minus 0.5%. Only one of your equity managers posted a positive return in the second quarter. It happened to be your largest equity manager, and that's Pinnacle Equity. They're your large cap core with a growth bias manager. They were up 6.2% versus 4.3% for the S&P 500. Pinnacle continues to do a very good job as your large cap core and growth manager. Your mid-cap growth manager, Janus Henderson, lost less than its target index, but still posted a negative return. And your 3 value-oriented managers, Brandywine Global, Harbor Mid-Cap Value, and American Century Small-Cap Value, all posted negative returns and all slightly lagged their benchmarks. It's been a tough environment for value across all capitalization ranges. On your international and global equity team, Janus Henderson was the only one global growth manager to top their index for the quarter. And your other managers came in with flat to positive returns, but lagged their target, those being American Funds Capital World Growth and Income, and Dodge & Cox International stock. Your emerging manager lagged the index, posted a positive return, but was up only 0.6% versus a 5% for emerging markets. You can see on page 25 that Invesco Developing Markets Fund has had a tough stretch of performance the past 18 to 24 months. And Chris and I are suggesting that for next quarter or for year end, that we provide the committee with a screen or a search report for emerging managers, emerging markets managers. And if the Invesco Developing Markets Fund does not improve its performance trend, you'll be in a position to make a move if you decide to do that. Your real assets team, you have 3 real estate managers or 3 REIT managers, 2 of which are domestic and 1 of which is global. And you have a commodities natural resources fund. And the real assets team did outperform its benchmark, but it did not avoid negative territory in the second quarter. Your 2 domestic REIT funds did post positive returns versus a negative performing index, so they held up quite well. PGIM Global REIT outperformed its target, but by falling less than its target, it edged ahead. And your commodities natural resource manager is an ETF index fund, and it fell in line with the commodities natural resource index. So that's your sort of your performance by manager for the second quarter. Are there any questions on the team or before I move on to the asset allocation and rebalancing?
I don't see any.
Okay. Chris will be providing you with an update on the July and August performance, but I'll just finish off with the asset allocation. And if you go to page 17 of your report, you'll see an asset allocation table which provides you with your current target asset allocation, your strategic mix. That's in the third column labeled target allocation. It's 44% in fixed income, 21% in domestic equity, 20% in international and global equity, and 14% in real assets. To the left of that column, you see the plan's actual allocation as of June 30th. And we are beginning to shift the plan towards the new asset allocation. There were 2 rebalancings that occurred in the second quarter in April and in May to begin moving towards the target allocation. And we proposed in the June flash report the third tranche of making a move towards the new allocation. And those trades or those recommendations can be seen on page 19 of the report, and they focus on reducing overweights to equities. In this rebalancing, we focused on reducing an overweight to small cap. We had reduced large and mid cap a little bit in March and in May. We are also reducing some of the REIT exposure, both global and domestic REIT exposure, and moving that money up into fixed income. to help bring the fixed income closer to the new 44% target, and also to replenish operational cash and keep it at a double weight of the target at 2% versus 1%. We think it's prudent for you to have 6 to 9 months of benefit payments and other expenses in operational cash when the markets are as volatile as the markets have been, so that you don't have to liquidate into a volatile market and hopefully a negative market. And these rebalancings were approved, and the trades were executed in July 23rd to be specific. And the last column on that asset allocation table on page 19 shows the resulting allocation. So as of July 23rd, your resulting allocation is there, and it is moving closer to the target allocation. We anticipate doing another couple of rebalancings this fall, and you should be quite close to your new targets by year end. Okay. So, any questions on the asset allocation or rebalancing to date?
I have one question. So this is the trade recommendation. Is this the same one that we just did in July?
Yes.
Okay. So you don't need any approval of that today because we've already done it.
Correct. That's done. That was executed on July 23rd.
Right. Okay. Just double checking.
Yeah. Well, Chris, why don't you, if there's no other questions, why don't you provide an update through July and talk a little bit about August?
Yeah, great. Good morning, everybody. I will touch on July performance. I think you have a flash report in front of you. This represents the first month of the new fiscal year. But I'll turn to page 2 and highlight asset class performance. It was a month that was favorable for the portfolio. Not only did we get strong performance from fixed income, but equities as well. But you'll see in July, really kind of, I think, the theme that emerged here is we saw some softening with inflation print and a softening in the labor market. And this really kind of opens up an opportunity for the Fed to embark on a interest rate cut in September. So bonds really rallied on these prints around inflation in the labor market. The U.S. core bond market, as measured by the Barclays Agg, was up about 2.3% for the month of July, and improved its year-to-date performance to about 1.6%. We also had some solid numbers from high yield, which was up about 1.9% as well. So as interest rates, trended lower, bond prices, given the inverse relationship, increased accordingly. And then if I can move your eyes to the middle of the page, really kind of equities performance, I think we'd classify this as really a classic rotation during the month. So for the last, I would say, 12 to 18 months, mega cap, large cap tech companies with an AI focus have been the clear darlings, clear winners. And in July, you saw a rotation away from mega cap into small cap, and the margin of performance was significant. So the S&P was up about 1.5%, but if you look just to the right, U.S. small caps were up 10.2% for the month of July. And the reason is, we get a little concerned with valuations in sort of the large cap. Maybe, mega cap has gotten a little bit ahead of itself from an earnings perspective, from a valuation perspective. And then small caps will really benefit from interest rate cuts. This is a segment of the marketplace that relies on traditional borrowing methods. So if the Fed is inclined to move forward with interest rate cuts, this will certainly be beneficial for small cap stocks. So you can see the Russell 2000 was up 10.2% for the month of July. And then we did see a meaningful rotation away from growth style investing to value style. So segments of the market that performed well, like financials, utilities, REITs, interest-sensitive areas, outpaced growth style investing. Solid returns weren't isolated to U.S. equities. We had strong results from developed markets. We're up about 2.9% for developed markets. And emerging markets, think along the lines of China and India, Latin America as an example, was modestly higher at about 30 basis points. And then just to the right, obviously in a conducive interest rate environment where interest rates trended lower and renewed optimism of Fed rate cuts, REITs had a really good month. You can see REITs were up 6.2% for the month as interest rates trended lower. So when we look at the performance of the capital markets on page 7, how it impacted the portfolio, you can see that the portfolio was up 3% for the month net versus the benchmark, which is up 2.9%. Year to date, which would be from January 1 through July 31st, the portfolio is up 7.6% versus the benchmark at about 7.1%. So we've got about 50 basis points of outperformance on a year-to-date basis. And if you just look to the right, when you look at summary of cash flows, when you monetize those results, you can see for the month alone, we generated about $5.4 million in gains. So we had an ending market value of about $184.4 million. And year to date, that 7.6% return equates to about $13 million in gains. So a strong month to kick off the new fiscal year. Maybe if there's any questions at this time I could answer, happy to do so.
Happy New Year.
Yeah. So let me just give a quick update on August. As Natalka mentioned, first week of August was pretty volatile. We had a meaningful sell-off and then a sharp rebound. But we did run the numbers through the close of last Friday. So despite all the volatility, the initial sell-off and then the sharp rally, the portfolio is actually up about 32 basis points for the month of July. So year-to-date through, the month of August. Sorry, thank you, Natalka. Yeah, 32 basis points. So through August 16th, which was last Friday, we were up about 8% on a year-to-date basis. So from January 1 to August 16th, we were up about 8%. So, solid results across the board, despite the volatility that we've witnessed. And one of the better performing asset classes here in the third quarter, in July and August, has been fixed income. So to Natalka's point, kind of the judicious approach we've taken about stepping into fixed income, right? We did an allocation in March, we did an allocation in May, and then in July, has paid off, pretty nicely, taking that sort of dollar cost averaging approach, given the performance of fixed income. So fixed income has really, provided that return profile that has been so sorely missed over the last decade, right? We really had to rely on equities to drive a lot of the performance, and right now, year to date, the ag is up almost 4%. And so, you're more than 50% of the way there on your discount rate. So again, the restoration of higher yields has really been a clear winner for so many plans, given that we rely on fixed income to provide that balance in a portfolio setting. Natalka, is there anything else you wanted to address in the flash report?
I don't think in the flash report, no. I mean, there on later pages in the flash report, you can see the performance through July 31st of the individual managers, and they had a good month. There was a lot of green and yellow shading in the monthly column. So, as Chris mentioned, a good month and a good start to the new fiscal year.
Yeah, I think on a year-to-date basis, we're getting some good value from fixed income, equity, and our REIT managers relative to their benchmarks. So, obviously 1 month of performance, can vary, but overall solid results.
Absolutely.
Great.
Who was the one you wanted to put on watch for
Invesco,
Invesco? And
Invesco Developing Markets.
they looked okay.
they pulled it together for
I
July,
think-
apparently, right?
Yes,
Okay.
they had a bit of a rebound in July, and so we'll be keeping an eye on them, and we hope to see that rebound continue. And if not, we just want the committee to be in a position to make a change if it's warranted, if it's necessary.
Great. Are there any other questions
the-
I'm sorry, go ahead.
Oh, yeah, I was just going to say, in closing, for some comments on the second quarter report, on page 39, excuse me, not 39, let me just get to the right page. Okay. On page 29. Fiducians has a governance calendar. Each quarter of the year, we focus in on providing you a slightly deeper dive into certain aspects of your plan, which are sort of significant fiduciary responsibilities. In the second quarter, we did, in addition to the investment review, a portfolio expense and liquidity review, and we provide the results of that on page 30. The average investment portfolio expense that your plan has, so average of the management fees, is 48 basis points, so a little under 0.5%, which is competitive for a plan that does not use a lot of index funds. You have a lot of active strategies. And on page 31, we show the underlying investment management fees for each of the funds that you're invested in. So you can, so that you're tracking that. We also included in the second quarter governance calendar a review of the Pinnacle custody costs, which are an annual asset-based fee of about 5 basis points. So, and your portfolio is fully liquid. You do not have any private investments, so you can liquidate any position, on a T+1 day trade basis. So if you're curious about what you have to look forward to on the fiduciary governance calendar for the third quarter report, we will do an annual actuarial review. If we'll work with Amy to just sort of update your funded status, your liabilities, accrued liabilities, and actuarial value of assets, and just sort of provide you with a summary in that regard. And then Chris will also provide a review of the municipal or public funds landscape. So just so you have maybe some ideas as to trends as to what some of your other peers are doing in the municipal and public fund space and what their experiences are. So.
Great.
Thank you.
Okay, well, I do have one item of other business. The last few years, when the city council has given raises, public safety has gotten more than what our actuarial firm has kind of assumed for raises. They assume 4% citywide, and those increases for police and fire have been significantly higher the last couple of years. So I asked Amy if she could look at adjusting the public safety assumption. And so she recommended doing just a study of how that would impact if we did a short-term increased amount for public safety raises for the next few years, and then see if it kind of levels off after that. So the cost of that special study is $5,000, but I would recommend that we ask them to look at that, because I think that's also part of why we're seeing a larger bump up each year on our annual contribution rate as well. So,
Probably a good idea.
yeah. So if I could get a motion to approve that, I would appreciate it.
Motion to approve.
Okay.
Second.
Okay. Frida, please call the roll.
Amanda DeRosa,
Aye.
Earl Hall,
Aye.
Greg Sample,
Aye.
Kathy Smith. Aye. Chair Tucker.
Aye. Okay.
No one's asked about COLAs on their participants, correct?
No, well, I mean, nobody's asked me about it. I know that a few years ago, we had Michael Guyton look at what the cost of that would be, and we may ask Amy at some point to evaluate that as well. I know that the issue with the COLA is you have an annual, increased expense, obviously, but we also have to fund that right away.
Right.
And so there's an immediate recognition that has to be considered. And I think the last time we looked at it, that's probably been 5 or 6 years ago, we were going to need to contribute like immediately somewhere around, I know it was in the six figures, I can't remember how much, on top of the annual contribution increasing. So if that comes up again, then I'll ask Amy to look at it, because I can only imagine that number
more.
has increased.
Yeah, okay.
So, yeah. All right. Is there any other questions or information from the committee? Okay, seeing
you,
none, we're
Talking Chris.
adjourned. Yes, thank
Thank
you,
you.
Talking Chris.
Thank you.
Okay, thank you.
We will adjourn. Thank y'all.